Welcome to the Deep Dive, where we unpack complex information to give you the clearest insights. Today, we're diving into the fascinating and often contradictory world of Bitcoin. The last 24 hours have been particularly dynamic, haven't they? Bitcoin's trying to reclaim a pretty critical psychological level, all amidst, well, a complex market environment.
That's right. What's really interesting here is this powerful tug of war playing out. On one hand, you've got really robust institutional demand. It's clearly setting a sort of resilient price floor. But then on the other hand, broader market sentiment, well, it suggests a strong undercurrent of caution, especially, with these big macroeconomic events looming.
Okay, let's unpack this for you. Our mission here in this deep dive is to really pull out the most important nuggets of knowledge from all the latest market intelligence. We'll look at those powerful institutional forces you mentioned, some intriguing technical patterns popping up, the looming macroeconomic pressures, and ultimately what all this means for the broader crypto ecosystem. Get ready to cut through the noise and really understand what's shaping the market right now.
So Bitcoin has definitely shown some notable resilience. It's currently hovering around, $109,400, about 1.75% in the last day. But this recovery is happening right around that crucial $110,000 mark.
Yeah, and that's key.
It's been volatile, though, really struggling to maintain its footing consistently above that level. Analysts are even calling the market fragile.
Indeed. Fragile is a good word. This struggle isn't suggesting a decisive breakout yet. It's more like a period of fragile consolidation. But what's really crucial to grasp is the successful defense of that $107,000 to $108,000 support zone.
And that robust buyer response we saw there, it shows a strong underlying bid in the market. Basically, it's stopped a deeper fall. Now, from a broader perspective, holding above $110,000, that's key for building momentum towards the next resistance level, around $115,000, that could potentially set the stage for, a continuation of the bull market.
And the flip side.
Well, conversely, if it fails to hold this level, we could easily see a retest of the $100,000 mark.
Okay, so how is all this translating into the immediate price action? I keep seeing this buy-the-dip activity, especially from institutional players. Is that really the main thing absorbing the selling pressure, particularly after that mid-August dip from the all-time high, which is around $124,500?
It absolutely is a primary driver, yes. The really critical insight here is that these U.S. spot Bitcoin ETFs, they aren't just attracting capital, they're fundamentally shifting Bitcoin's market structure. Well, that $440 million plus in net inflows just last week alone, that signals a new era, an era where strategic long-term institutional capital is establishing a genuinely resilient price floor. That fundamentally differentiates this cycle from past, more speculative ones.
And it's not just the ETFs, is it? Corporate treasuries seem to be deepening their Bitcoin bets, too, like MicroStrategy.
Yeah.
They're known for their pretty aggressive Bitcoin strategy. They just bought another 4,048 BTC, right, for about $449.3 million between late August and early September. That brings their total holdings to a, staggering 636,505 BTC. That's over 3% of all the Bitcoin that can ever exist.
Yeah, it's huge. And it really highlights this broader trend, the increasing institutional and corporate conviction in Bitcoin. We also saw that Japanese firm Metaplanet acquire another 1,009 BTC for about $112 million. That brings their total up to a significant 20,000 BTC.
Wow.
And looking at the wider implications, data from Bitcoin Treasury shows the top 100 corporate and institutional entities now hold, get this, 990,695 BTC. The market value on that is over $108 billion.
Horrible.
And 8 publicly traded companies expanded their holdings just last week. Names like Marathon Digital, Tesla, Block Inc. This consistent institutional and corporate buying, it effectively removes Bitcoin from the freely traded supply, which, can significantly impact price by reducing the available liquidity, especially when demand is high.
Okay, now this next development seems like a pretty significant convergence.
Yeah.
Media, politics, digital assets all coming together. Trump Media and Technology Group has announced a major strategic push into crypto, partnering with Crypto.com.
Yes, and what's particularly noteworthy here is their new entity, Trump Media Group CRO Strategy, Inc. It's backed by a substantial $6.4 billion investment vehicle. That's serious capital. They're making a calculated bet on CRO, the native token of the Kronos ecosystem.
And they're integrating it, too.
Exactly. They plan to integrate digital assets directly into Truth Social, letting users pay for subscriptions and services with CRO. And beyond just the token specifics, the involvement of such a high-profile, publicly traded company, one with strong political connections, Well, that could be a significant catalyst for broader mainstream adoption. It might encourage other traditional corporate entities to jump in, especially given their filings for a crypto blue chip ETF later this year.
Interesting times.
Hmm.
Okay, let's shift gears to the technical side. From a high time frame perspective, Bitcoin's chart is apparently showing some powerful patterns. Analysts are pointing to a bullish megaphone pattern on the daily chart. Can you explain that a bit? Like a megaphone opening upwards.
Precisely. It visually represents increasing volatility, think higher highs and higher lows. It often precedes a strong upward move. Its boundaries right now are roughly between $108,000 on the low end and $124,900 on the high end. A breakout above that upper boundary could target approximately $144,200 according to the pattern.
And there are even bigger patterns.
Well, zooming out further, yes. Technical Analyst Galaxy identifies a larger megaphone pattern spanning over 280 days. That one could potentially lead to an even more ambitious target of $206,800. And then you have influencer Faisal Beg spotting a similar bullish megaphone, but on the weekly time frame targeting $260,000.
Wow, those targets sound incredibly ambitious, especially given the recent volatility we've seen. How much weight should you, our listeners, really put on these technical patterns? Are they just highlighting upside potential in what's still a pretty unpredictable market?
That's a great question, and it's crucial to remember technical patterns indicate potential based on historical price action. They are not guarantees. Think of them as offering a kind of roadmap of what could happen. However, even as these charts paint this powerfully optimistic picture, there's a crucial counter-narrative emerging. It comes when we look at the actions of Bitcoin's largest holders, the so-called whales. Their moves introduce a really fascinating dichotomy here.
A dichotomy. Like seeing two different kinds of whales in the same ocean. Maybe one building for the long haul, the other hunting short term.
That's a fantastic analogy, actually. On one side, you definitely see signs of market maturation. For instance, a prominent Bitcoin OG whale, someone holding over $11 billion in BTC, recently rotated 4,000 BTC, worth about $435 million, into nearly 97,000 ETH.
Okay, so swapping Bitcoin for Ethereum.
Right. And analysts tend to interpret this as a sophisticated diversification play. Thinking of Bitcoin as digital gold, the long-term store of value, and Ethereum as digital oil for its utility, its yield-generating potential in DeFi and NFTs, this is generally seen as a healthy sign of a maturing ecosystem where large players are actively optimizing their portfolios.
Okay, that makes sense. But then what's the other side of this dichotomy?
Well, on the other side, you have David Bailey, the CEO of Bitcoin Magazine. He claims there's immense selling pressure coming from two specific massive whales. He alleges they've collectively sold something like 200,000 BTC. And he suggests this selling has been actively preventing Bitcoin from breaking through and reaching $150,000.
200,000 BTC. That level of concentrated selling, I mean, that would certainly be a significant headwind, wouldn't it? It directly contradicts the bullish technicals and all that institutional buying we just talked about.
Precisely. And this really highlights the inherent complexity of the market right now. While institutional demand is undeniably strong and growing, these large individual selling events can, at least temporarily, absorb that buying pressure. They can create friction at key price levels. It just underscores that even with all the positive inflows, you can't ignore concentrated selling from major holders.
Right. Okay, moving on. Bitcoin's price still seems highly sensitive to macroeconomic data, doesn't it? We saw that hotter than expected wholesale price inflation report recently. It triggered a pretty sharp negative reaction across risk assets, didn't it? Kind of dampened optimism for a near-term Fed interest rate cut.
Absolutely. And this places intense focus now on the upcoming U.S. jobs report. Here's why it matters so much. A weaker than expected report could suggest the labor market is cooling off. That would likely increase the probability of the Fed cutting rates.
Which would be bullish for Bitcoin.
Generally, yes. Easier money policies tend to favor risk assets like Bitcoin. Conversely, a strong jobs report could strengthen the U.S. dollar and reduce the urgency for the Fed to ease policy. That could put downward pressure on Bitcoin. Historically, we've often seen faltering labor market data lead to increased interest in Bitcoin, perhaps as a potential safe haven. So this report is undoubtedly a pivotal short-term catalyst for the entire market. You really need to watch it.
Okay, noted. Now, beyond Bitcoin itself, you mentioned a structural rotation of capital towards Ethereum earlier, particularly among institutions.
Yes, that's a significant trend we're observing. In late August, for example, U.S. spot Bitcoin ETFs saw roughly $2 billion in net outflows. But over that same period, spot Ethereum ETFs amassed around $4 billion in net inflows.
Quite a divergence.
It is. And what's fascinating here is how this reinforces that narrative we touched on earlier, especially for sophisticated investors. Bitcoin as the scarce, non-sovereign digital gold for long-term value storage, and Ethereum as the productive, yield-bearing digital oil foundational to DeFi, NFTs, Layer 2 scaling solutions, and so on. This structural shift, it has lasting implications for market dynamics. It could potentially lead to a period where Ethereum outperforms Bitcoin in certain aspects, indicating a, maturing, more diversified crypto investment landscape.
Interesting. Okay, turning to the mining sector now. It sounds like it's showing pretty robust health. I saw Iron Limited reported record quarterly revenue, $187.3 million, and adjusted EBITDA of $241.4 million. That's earnings before interest, taxes, depreciation, and amortization. A key measure of operational profit, right? They're apparently on track for $1 billion in annualized revenue.
That's right. And this really highlights an important question about diversification within the mining industry itself. Leading miners like Iron aren't just mining Bitcoin anymore. They're leveraging their expertise in energy and data center operations. They're moving into the AI cloud services market, actively replacing some of their older mining hardware with GPUs to cater to these demanding AI workloads.
So they're branching out beyond crypto.
Exactly. This move alone is projected to generate an additional $250 million annually in non-crypto revenue for Iron. We're also seeing new public listings in the space, like American Bitcoin, which is backed by Eric and Donald Trump Jr., preparing for a NASDAQ listing. These developments signal, I think, long-term health and resilience for the Bitcoin network and its underlying infrastructure. They're moving beyond relying purely on crypto mining revenue streams.
Okay, so strong spot demand, healthy mining.
Yeah.
But in contrast, the Bitcoin derivatives market seems to paint a more cautious picture. Open interest, that's the total number of outstanding derivative contracts like futures or options, right?
Mhm.
That's apparently declined, signaling a shift toward risk-off behavior.
Correct. And looking deeper into that, data shows put options, those are basically bets on the price going down, are priced at about a 7% premium over call options. That means traders are willing to pay more for downside protection.
Which tells you.
Well, this difference in price is known as a put skew, and it strongly signals underlying anxiety, a defensive posture in the market. On the CME, the Chicago Mercantile Exchange, for instance, the put-call premium ratio currently stands at 0.83, which further reinforces this cautious sentiment among derivatives traders.
Got it. So as we navigate all these complex, sometimes contradictory signals, strong institutions, cautious derivatives, whale games, it's crucial we don't overlook a persistent challenge: security. Even with all this institutional growth, the digital asset space still faces ongoing threats, doesn't it? August saw over $163 million stolen across 16 major attacks. That's a 15% jump from July.
Yeah, unfortunately.
And the largest incident was a really sophisticated social engineering attack on an individual Bitcoiner. They lost 783 BTC, worth $91 million, to scammers pretending to be support staff. Ouch.
It's brutal. And it highlights a really critical shift we're seeing in attacks. Exploiters are increasingly targeting human error, not just technical flaws. The centralized platforms absolutely remain targets too, as we saw with the BTC Turk exchange losing $54 million. So this raises an important question for you, the listener. These significant recurring events are a critical reminder, really, a reminder of the importance of robust personal security practices. Things like using multi-signature wallets, being hyper-vigilant against phishing attempts, and understanding the principle of self-custody, minimizing reliance on third-party platforms where possible. It's a constant battle, even as the market matures.
Wow. Okay. What a deep dive indeed. We've definitely seen Bitcoin's incredible resilience, haven't we? Buoyed by that institutional confidence in major corporate plays, even attracting these high-profile new entrants like Trump Media. We've also uncovered those powerful bullish technical patterns, but importantly, layered this with insights into that complex whale dichotomy and the critical influence of upcoming macroeconomic data, like that U.S. jobs report.
Absolutely. And we've tried to take a holistic view of the entire ecosystem, noting that structural shift of capital towards Ethereum, the mining sector's really innovative diversification efforts, those cautious signals coming from the derivatives market, and of course, the ever-present, ever-evolving threat of security breaches. It's clear this is a market in constant motion, driven by really diverse and often contradictory forces that demand careful, ongoing consideration.
So wrapping up, what does this all mean for you? Maybe consider this provocative thought. With Bitcoin caught between these powerful institutional tailwinds pushing for new highs and these inherent market fragilities like whale selling and macro uncertainty, how do you personally weigh that long-term bullish outlook against the very real short-term volatility and these evolving risks? What aspect of this deep dive resonates most as you navigate this rapidly changing financial landscape? Something to think about.